Hello and welcome to the Money Mile. We've been through some very difficult times and these times are going to continue for some more time. We are in the middle of a crisis, not just towards our physical health, but our financial health as well. We've seen a very sharp fall in the stock markets, and that has very logically led people to be in a state of fear. What can you do with your financial health at this point of time, with your investments, with your money? To answer some of those questions, joining me is well-known certified financial planner, Surya Bhatia. Thanks very much, Surya, for joining me. Clearly, a lot of fear out there among people. We've probably seen, and you can confirm this, a lot of panic selling as well. Though on the other hand, what we are hearing from some of the mutual fund CEOs is that people are also using this opportunity to buy at these low levels of the market. So first of all, what is it that an investor who has a portfolio right now be doing instead of going into a panic?
I think it's all about now understanding the basics now. I think it's real time that you really go back to basics. Understand what your allocations have been. In case you have been very aggressive investor because markets actually gave you upside for the money over the last 1 year when large caps really did very, very well. But the last 1 month has been typically a game changer for everyone. I think, and it's the large cap which actually led to the downfall. I think if you see a stock like Reliance or an HDFC correcting by 30, 40, 50% also, I think it's time you really need to take a stock of what are you really doing. I think it's very good if you look at strategizing yourself, making sure that your asset allocations are in order. What is more important over here is to start understanding that what your short-term needs are vis-a-vis your long-term needs. It's very, very basic stuff over here. Please make sure that your short-term cash flows are in order. We typically always have been saying and still say the same thing. Make sure you have a 3 to 6 months of cash flows ready with you. Out of this, it can actually be in balances in banks. It doesn't mean that you need to have cash in hand with you because your credit cards are working, the banks are working, you can go and withdraw money. So there's no need to panic beyond a point, to be very honest, Vivek. At the same time, you're also seeing, as you also mentioned, that you're also seeing buying at selective counters. People are trying to accumulate equity asset class but in a very, very steady manner, which is actually very good. There's no need to kind of buy in large quantity. If you have $100 to put in, you don't have to put in $100 today or tomorrow. Just stagger your purchases, just stagger it over the next 6 months, 9 months. But more importantly, understand your risk appetite. That's very important because these markets will really test your patience, will be highly volatile from even here onwards. But one very interesting aspect over here is that these markets will actually tell you a difference between what risk is and what volatility is. During a normal course of time, these two things actually gets merged together. People talk about risk and volatility as the same thing, which actually is not. So if you look at today's market, the risk level, while it's there, but it's actually on the lower side. Markets are already discounted. You are currently trading at a PE of around 17 to 18 multiple. It is the VIX, your volatility index, which actually at one point had jumped to 75, never seen before. Even in 2008 times, this level has not touched these numbers. It has really kind of come down a little bit, but it's still very high. And that's what you need to kind of worry about, because if you are able to stomach that volatility, I think it's reasonable sure that over the next 3-5 year period, mind you, that's the period you even need to look at from here onwards, because we don't know how long this continues, what is in store for you in the next few months. So you have to brace yourself for a little longer period of time, even than what you anticipate. So volatility is something which you have to be careful about. But if you can stomach that, then I think equity is an asset class you can slowly and steadily accumulate. And in today's time, it could be even safer than debt to a certain extent, if I can go and actually tell you. Because if this continues for long, the credit side of my debt will have a problem in times to come. So be careful, look at equity as an allocation, but don't go overboard. And there's no need to panic beyond a point. So don't get greedy too much and don't be fearful also too much.
So those who are already invested in equity mutual funds, a large number of people have investments there already, and those who do not need the money, in this kind of a situation from a liquidity point of view, because not too many people probably follow the financial planning norm of keeping 3 to 6 months as an emergency corpus. So other than those who don't require the money, do you believe that if you are okay without requiring this fund for the next, say, 2 to 3 or 5 years, you should just sit tight and weather this storm rather than trying to catch a falling knife and saying that, look, I expect the market to fall another 10%, so let me get out right now?
And you're right, because to be honest, we have been getting calls, and primarily the calls have been that we will actually get out of the equities right now. And because we believe, that's what we tend to hear, that we believe that markets will actually correct from here by 10 to 30%. That's what we tend to hear in the markets these days. And then we'll actually invest in the markets when the markets are down 30%. Now it's very, very hard for anyone to really catch the falling knife, to enter the markets when it's 30% down. So let's take an example over here. So assuming, let's say the market does correct 30%, I don't want that to happen, but assuming that happens for a minute, it goes down by 30%. Do you think that whether you or I, over at that point of time, will be in that frame of mind to invest the money when the markets have corrected from today's level down by 30%? Because then your psyche will work in such a manner that you will come back and tell me or tell any one of your advisor or think about yourself is that markets can further go down by 30%. That's how your human tendency works. So there is no way you can enter. The next counter which can happen is, okay, I may not be able to enter at 30% downside, but I will be able to enter the market at down 15%. Now that's a very difficult one. You may do it, but as a percentage of investors, it'll be more by luck rather than by choice. So we currently are recommending to all investors that if you have your debt allocation safe and steady with you, you have your money available to you for the next 1 year of your cash flows, and you can look at this balance money, which is actually, let's say right now in the equity asset class, please be there. Don't look at exiting equity in the current scenario, because this is nothing to do with the equity markets per se. It's a global phenomena, and equity markets are a byproduct of that. Because of the companies not working, everyone is in a lockdown stage, everyone has to face the pressure, and therefore it comes to equity by default. But if you hold on to it for a longer period of time, there is no reason why you will not be able to come back and recover your lost money also and make money on that.
What about debt, Surya? We've seen a very strong set of measures coming in from the RBI, a massive
Yeah.
rate cut. What does that mean for the debt mutual funds? Because they've also been struggling for the last 6 months to a year. With this kind of a sharp rate cut and other measures that the RBI announced, do you see debt funds? Because again, I'm presuming and I hope that people have followed asset allocation. They're not only into equity or only into debt. They've got a good mix of both equity and debt. So while equity has fallen very sharply, debt wasn't doing well. But do you see a turnaround there in terms of the returns post the RBI measures?
Yeah, you saw a rally in the debt markets post the RBI measures, but it's not very easy for debt because there can be a strong selling on the debt. RBI did what it could. It actually went overboard in cutting the interest rates just to create more liquidity in the system, both at the investors level as well as at the banks level, by cutting both the repo as well as the reverse repo rates. Now, this is actually good for the debt fund because as the interest rate go down, they have a inverse relationship with the yields. Therefore, the debt investors actually gain because of that falling in the interest rate prices. But what you will find investors losing out is that that shortly you will see the fixed deposit rates also coming down. So anyone who's into a fixed income security like a FDs or corporate deposits or even a PPF for that matter will actually see a fall in the interest rates. And with this dramatic cut in the interest rates, I think I'll not be surprised if the FDs currently will eventually trade at around 5.25 from the current 6.5%, which is not seen of in India. Typically, you see it more in the developed countries when the interest rates are coming down so dramatically. But I think that's the new norm. But coming back to a debt mutual fund, I think the investor need to make sure that they try to prune the portfolio gradually. There's no need to kind of react or overreact on this, and try to move to a little more higher quality portfolios to see that I am moving out from a low rated paper to a AAA rated paper. and just try to see how the debt can mitigate the effects of a downside risk which you may carry on the credit rating side. So while the RBI may not let the rating agencies do that right now, but I think it's a good financial prudence on the investor side to start doing this exercise as the times goes by. Because if this really continues for long, then you could see some pressure building up on corporates. And any corporate with a little weak balance sheet will actually face a more difficult times in the times ahead.
Has asset allocation worked for people in this, dramatic fall? So, for example, if there was a client of yours who had say, a 50-50 mix of equity and debt in their portfolio and had done the asset allocation through you, uh, have they seen, a very sharp fall as well? So, if I were to look at, say, the Sensex, which is down over 30%, but for a balanced portfolio of 50% debt, 50% equity, what typically has the fall been like?
You're very right, because if some investor has done a 50% allocation between debt and equity by default, my Sensex has gone down for the last 1 year. Average is around 26% down as of today. So my portfolio of 50 rupees is down by 1/4 of that value. So that has become 37 rupees broadly. And my debt portfolio, even if you have some portfolio which actually have defaulted in between during the course of the last 1 year, still gave you a CAGR of close to around 6-7%. That still holds true. So your average return, which if had you been a 100% equity investor, which had been down by 26%, right now as we speak, you will be around 20% down. So that speaks a lot, because you actually stand to gain and you covered your losses. And in times to come, you're still protected. You even have your cash flows in order. You have the money available, because you will not like to redeem equity in case you need some cash. So therefore, it also gives you cash flows, money in order, money available. And even you can even think of doing a rebalancing, because some investors are looking at doing a tactical allocation of increasing the equity from that 50%, which has now become, let's say, 37%, to bring it back to 50% level. Which means what I'm doing is I'm doing a rebalancing one. I'm even doing a tactical allocation of increasing my equity from 37% back to 50%, which you may even want to bring it back down to the original 50% level after 3-4 years when the market recovers back, therefore giving you a little bit alpha in the portfolio. So it actually gives you flexibility to maneuver your portfolio in such a manner that in these tough times, you can try to see how opportunities can be created so that your portfolio can actually work more hard for you.
Pleasure talking to you. Thank you very much, Surya. And we will keep coming back to you over the next few days as well. I know there are a lot of concerns which a lot of you have out there. If you have any question for us, please feel free to write into us, reach out to us, and we'll be very happy to help you in getting Surya to answer those questions. Thanks for watching. We'll be back with lots more. Take care, stay home, stay safe.
Thank you.